Welcome back to The Explainer. Today, we are looking at a market that just experienced some absolutely massive technical swings. I mean, we're talking about a completely violent semiconductor bounce, major tech earnings from heavyweights like Apple and Amazon, and of course, the underlying macro data that's really steering these moves. So let's jump right in.
So here's our roadmap for this explainer. We're going to start by unpacking this massive semiconductor margin call. Then we'll move into macro data and currency, dissect those massive earnings from Apple and Amazon, analyze Microsoft's insane technical breakout, and then wrap the whole thing up with a look at the broader market outlook.
All right, part one, the semiconductor margin call and leveraged retail losses. The absolutely crucial thing to understand about the violent semi-rebound we just saw is what actually triggered it. Basically, it was preceded by severe, downright ugly losses for leveraged retail investors, especially in the semi and memory sectors. That triggered a massive margin call cascade. To put that in perspective, in Korea alone, over 1.2 million retail leveraged accounts hit their margin call thresholds. That forced anywhere from 320,000 to 460,000 accounts into flat-out liquidation.
And you've got to notice the demographic impact here, because it's wild. A staggering 62% of those liquidated accounts belong to young investors. We're talking people between 20 and 30 years old. The pain was just everywhere. Out of 880,000 retail buyers of Samsung stock, nearly half are sitting on a loss right now. And for the 408,000 SK Hynix investors, nearly 70% of them are currently underwater.
The sheer scale of this drop is mind-blowing. We're looking at a 70% plunge, from a $50 billion peak all the way down to $16 billion. That just shows you the massive scale of deleveraging, which, is when investors are quite literally forced to sell off assets just to cover their debts. Now, while this specific deleveraging phase might be wrapping up, there is a stark warning here. If retail investors just jump right back in with high leverage, hoping to quick fix their losses, another crushing margin call could easily follow right behind it.
Okay, moving on to Section 2, macro data and currency. Let's zoom out to the broader macroeconomic environment and those huge currency moves that really set the stage for all this market chaos.
So the US dollar saw a massive drop against the Japanese yen. Actually, it was its largest single-day decline since December of 2023. This was driven by coordinated intervention from the Bank of Japan and US authorities stepping in to prop up the yen. Meanwhile, looking at the US economy, June core PCE, which is that key inflation metric based on what consumers are actually spending, rose 3.3% year over year. We also saw Q2 preliminary GDP growth slow down to 1.5%, missing expectations, while jobless claims came in at 197,000. So what we're looking at is a picture of slowing growth paired with stubbornly persistent inflation.
Next up, Section 3, Apple's surprisingly mixed earnings bag. Let's really dive into the heavyweights, starting with Apple, because their quarter was, well, pretty complicated. On the surface, Apple reported earnings per share of $2.02 and total revenue of $109.42 billion. The iPhone beat estimates, bringing in a solid $54.25 billion, up 22%. Mac revenue also jumped an impressive 29% to $10.35 billion. But wait, here is the absolute crucial takeaway. Services. This is Apple's most profitable segment, and they unexpectedly missed expectations. They brought in $30.74 billion compared to the estimated $31.36 billion, missing by nearly $1 billion in your main growth engine. Yeah, that is a massive headwind.
And when you look at the geographic breakdown, it reveals this huge shift. Think about last quarter. China basically propped up a weak US market, right? Well, this quarter, it is the exact opposite. The Americas actually grew 11% to $45.78 billion, but those other critical markets just faltered. Greater China reported a measly $1.82 billion in revenue against an expectation of nearly $20 billion. And Japan also missed estimates, coming in at $6.55 billion.
All right, let's pivot to Section 4, Amazon's AI investments. Over at Amazon, we're seeing a drastically different and honestly highly successful outcome, completely driven by aggressive AI investments.
Amazon delivered an absolute monster of an earnings beat. Net sales hit $206.1 billion. But the real star of the show here is the cloud segment. AWS revenue just surged to $42.23 billion. That is a massive 37% jump. It's actually their fastest growth rate in 18 months, which totally proves that enterprise adoption of their AI services is just accelerating like crazy.
The really interesting thing here is the contrast in strategy between these two giants. Over the last year, Apple has basically played it safe, acting as a low CapEx, low capital expenditure, safe haven, while all the other tech giants were just bleeding money into this AI arms race. Amazon, on the flip side, just took their 2026 CapEx target and raised it from $200 billion to $220 billion. That's a 56% year-over-year increase, just pouring capital straight into data center construction.
And you know what? The market is totally rewarding them for it because, simply put, investment produces returns. Amazon is actually out there successfully monetizing its AI, and it's pushing its operating margin to a super robust 13.7%. They are proving, beyond a doubt, that these heavy, aggressive data center investments are generating real, accelerating revenue growth right now.
Section 5. Microsoft's historic technical breakout. Shifting gears over to Microsoft, we just witnessed a violent 15% surge. Guys, that marks its best single-day gain in 18 years. Let that sink in.
The mechanics of this move were absolutely textbook. Microsoft essentially gapped up, which, if you aren't familiar, means it opened significantly higher than its previous close. It opened right at $437.90, cleanly slicing straight through that critical $435 resistance level. A core trading rule to remember is that a true technical breakout is confirmed by the opening or closing price, not those intraday chops and fluctuations. So by opening above resistance, it instantly broke the downside defense, and that resulted in a relentless upward push all day long.
Finally, Section 6, the market outlook. With all these massive tech surges we've just walked through, it brings us to the ultimate million-dollar question. Is the recent market sell-off officially behind us? To really answer that, we have to look under the hood at market mechanics. A huge chunk of this recent violent tech bounce can actually be attributed to a massive options squeeze right before Friday expirations. Essentially, market makers got hit with the largest short squeeze we've seen in 4 months. They were forced to aggressively buy up underlying stocks just to keep their positions neutral, which, mechanically speaking, drove prices exponentially higher.
So, what's the takeaway? Ultimately, you can't just judge this as the start of some lasting recovery where everyone's confidently buying back into risky assets. It's primarily a technical bounce, driven by option squeezing and margin covering. The reality is, major indices still need to test some very significant overhead resistance, like that 693 to 724 level on the QQQ.
The underlying trend hasn't fully reversed yet, not by a long shot. So, as we head into next week, you really need to ask yourself, are you trading a true fundamental recovery, or are you just getting caught up in a mechanical illusion? That's all for this explainer. Thanks so much for joining, and we'll catch you next time.